Welcome to this deep dive. We're digging into some really key topics for anyone working in the Luxembourg financial world today.
That's right. We're focusing on share premium and account 115, two pretty important equity concepts.
Exactly. We want to unpack what they are, how they actually work in practice.
Right.
The governance side, the paperwork, and crucially, the legal and tax side of things.
Especially with that significant court ruling from 2022 impacting account 115. We definitely need to cover that.
Absolutely. Our goal here is to make this clear, especially if you're in law, finance, compliance, governance, but maybe not an accountant day-to-day.
We've looked at legal analysis, official sources, basically trying to give you the essentials.
So Luxembourg corporate law offers quite a bit of flexibility, doesn't it, beyond just standard share capital?
It really does. And these two mechanisms, share premium, prime d'émission as it's known, and account 115, apport en capitaux propres non rémunérés par des titres. Quite a mouthful.
Ah, yes.
They really show that flexibility in how you build and manage a company's equity.
Okay, let's start with share premium then. Account 111, what exactly is it? I know the law doesn't spell it out word for word.
No, it doesn't. But the general consensus, and it's pretty strong, is that it's the extra amount paid for new shares. So anything above their nominal or face value.
Right, like if a share has a nominal value of 10, but an investor actually pays €100 for it.
That extra €90 is the share premium.
Exactly. It's considered an additional contribution. It sits in equity, but it's, distinct from the actual share capital itself.
And its main job, why have it?
Well, primarily it's about fairness. Financial equality between new shareholders coming in and the existing ones, especially if the company's value has gone up since the first shares were issued.
Makes sense. So how does it actually get created?
It happens when a company issues new shares and decides formally to set the issue price higher than the nominal value. Pretty straightforward genesis, really.
And who makes that call? The board.
It's just shareholders.
Usually it's the general meeting of shareholders. That's the default. However, the company's articles of association can give that power to the board of directors, maybe within certain limits.
Okay.
But either way, that decision absolutely has to be recorded properly in the meeting minutes. Documentation is key.
Okay, now the interesting part for many advisors, getting that premium back to shareholders, repayment. It's not just like handing out dividends, is it?
No, definitely not. There's a really critical legal test involved. It's called the net asset test.
Ah, yes, the net asset test. Article 4612 for SAS and 71025 for SARLS under the LSC. Used to be 72-1, I think.
That's the one. And it's fundamental. Basically, a company cannot make any distribution, and that includes repaying share premium, if doing so would make its net assets drop below the total of its subscribed share capital, plus any reserves that are legally non-distributable.
So it's like a minimum buffer required by law, a safety net.
Exactly. It protects the core capital, that intangible share capital, and things like the legal reserve. They can't be touched for distributions.
So repaying share premium isn't profit distribution, it's return of capital. But it still has to pass this test.
Precisely. It's a return of capital, not profit.
Yeah.
But that hurdle still applies. The upside is, though, a company can repay share premium even if it's had losses in the past.
Really? Even with losses?
Yes, as long as, after the repayment, it still meets that net asset test. That's the crucial condition.
Okay, so what's the actual process? If a company wants to repay share premium, what are the steps?
Right. First step. The board of directors needs to propose it. They have to confirm the company actually has the available funds and meets the test.
And this is where documentation gets critical again, I imagine.
Absolutely.
Yeah.
And ideally, crucially, that proposal from the board should be based on recent financials. We're talking an interim balance sheet, maybe a P&L too, that's no more than 2 months old.
Why so recent?
To ensure the decision reflects the current financial reality. You don't want to base a distribution on old numbers that might not hold true anymore.
Makes sense. And after the board proposes?
Then it goes to the general meeting of shareholders for the final formal approval. They have the ultimate say.
And you mentioned articles of association earlier. It helps if they mention share premium availability.
Oh, definitely. Having clear clauses in the article stating that share premium is available for repayment, subject to the legal limits, of course, can make the whole process much smoother down the line.
So documentation-wise, we need the articles, the board resolution proposing it. What else?
That board resolution needs to be detailed. It should state the amount, confirm the net asset test is met, and critically reference that interim balance sheet, the date, maybe a summary. Then you need the shareholder resolution clearly approving the specific amount.
And convening the meeting itself needs to follow LSE rules too, right? Especially if distribution is on the agenda.
Yes, absolutely. All the notice periods and information requirements apply. And then keep everything. Signed minutes, the interim financials, notices, updated shareholder lists, accounting records. Meticulous records are non-negotiable.
Got it. And just for context, for those not deep in the PCN, the Luxembourg Chart of Accounts, where does share premium sit?
It's account 111, peine de démission. It's under Class 1, which covers equity, provisions, and financial debt. So clearly classified as equity.
Okay, crystal clear on share premium. Let's shift gears now to account 115, that rather long name again.
Apport en capitaux propres non rémunérés par des titres. Yes.
Which just basically means a capital contribution to equity, but without getting shares back.
Exactly that. Shareholders contribute funds, or maybe assets, directly into the company's equity, but crucially, they don't get any new shares issued to them in return.
So it boosts the company's equity base, strengthens the balance sheet.
But without changing the ownership percentages at all. No dilution for existing shareholders.
When would a company typically use this?
Often for things like financing specific projects, funding expansion, or just generally shoring up the balance sheet, perhaps more quickly or simply than a formal share capital increase.
So advantages are simplicity, speed maybe, and no shareholder dilution.
Those are the main draws, yes. It can seem quite straightforward.
And this sounds like a big but. There was that major court ruling in March 2022. That changed things for account 115, didn't it?
It really did. A landmark ruling from the Luxembourg Administrative Court with significant legal and especially tax implications.
Okay, what was the core finding?
The court stated very clearly that contributions made to account 115 cannot be included when you calculate the acquisition price of a participation.
And this is for the purpose of Luxembourg's participation exemption regime, the rules that can exempt dividends and capital gains.
Precisely. We're talking Articles 147, 149, and by extension Article 166 of the Income Tax Law, the LITL. These rules often rely on meeting certain investment thresholds measured by acquisition price.
So why did the court say account 115 contributions don't count towards that price? What was the logic?
Their reasoning focused very tightly on the phrase participation in the share capital. The court interpreted this to mean something directly linked to acquiring shares, either getting more shares, increasing their nominal value, or maybe direct costs like notary fees related to getting those shares.
And account 115 contributions
don't involve issuing shares. So in the court's view, they simply don't meet that definition. They aren't part of acquiring a participation in the share capital.
Okay, let's make that concrete. What's the practical impact for, say, a holding company using this?
Well, think about the thresholds for the participation exemption. There's often a minimum investment required, like $1.2 million for a dividend exemption, or $6 million for capital gains exemption if you don't meet the 10% holding threshold.
Right.
Money put into account 115 won't help you reach those thresholds. Only money directly linked to getting shares, like actual share capital or traditional share premium paid upon issuance, will count.
Wow. So this draws a really sharp tax line between account 115 and formal capital or share premium.
A very sharp line. It fundamentally changes the calculation when deciding whether to use account 115. What might look simple from a corporate law perspective now carries a potential significant tax disadvantage. You really have to weigh that up.
It really seems to underscore that legal substance, the fact no shares are issued, trumps the accounting classification, doesn't it? Even though it sits in equity on the balance sheet.
Absolutely. The court looked straight through the accounting to the legal reality of the transaction.
So how are contributions to 115 actually made then? And what about repayments?
Making the contribution usually involves an agreement between the shareholder putting the money in and the company, typically its management body. A formal written contribution agreement is now, I'd say, more critical than ever.
Especially after that ruling.
Definitely. And repaying those funds. It's treated just like repaying share premium or paying a dividend. It's a distribution to shareholders.
Meaning the net asset test applies here too.
Yes, same test. Article 4612 or 71025 LSC. The company's net assets must remain above subscribed capital plus non-distributable reserves after the repayment.
And the procedure for repayment. Similar to share premium.
Very similar. Board proposes it, ideally backing it up with recent interim financials. Then, the shareholders give the final approval in a general meeting.
Okay, so given the court ruling and the nature of 115, what's absolutely essential in terms of documentation now?
That contribution agreement is paramount. It needs to be explicit. State the amount, clearly label it as going to account 115 using the full French term apport en capital propre non rémunéré par des titres.
And crucially,
state unequivocally that no shares are being issued in return. That's vital post-2022. It's also good practice to mention the intended permanence and any conditions for repayment, always subject to the LSC rules, of course.
and revolutions.
You need board minutes accepting the contribution, referencing that agreement. For repayment, you need the board proposing it with the financial justification, referencing the net asset test and interim financials, and then the shareholder resolution approving it.
And keep records of everything naturally.
Agreements, minutes, accounting entries, everything needs to be accurate and readily available.
Okay. And just to circle back to the PCN for non-accountants, Account 115 is also in Class 1 equity?
Yes, it is. Interestingly, since a 2009 update, it's actually grouped under the same general heading as Prime Domicile Prima Similes, Share Premium, and similar items.
But that grouping doesn't change its fundamental nature.
Not at all.
Yeah.
It's still distinct precisely because it's not linked to share issuance, and the 2022 tax ruling just hammered that distinction home. Governance around 115 now absolutely must factor in those tax consequences.
So if we put them side by side, share premium, account 111 versus account 115, key differences.
Okay, quick recap. Share premium, 111, arises from issuing shares above nominal value. It's directly linked to those shares. And importantly for tax, it does generally count towards the participation exemption acquisition price.
Whereas account
Now,
115
He is a direct equity contribution without issuing shares.
Yep.
No link to specific shares. And the big one post-2022, it does not count towards that acquisition price for the participation exemption.
both need the net asset test for repayment, but documentation and the tax angle are quite different.
Exactly. The governance procedures are similar for repayment, but the documentation around creation and the tax impact are worlds apart now.
So if a company or its advisors are trying to decide which route to take injecting funds via share premium versus account 115, what should guide that decision?
Several things. Tax objectives are probably top of the list now. If that participation exemption is key, structures involving actual share issuance, like capital increases with premium, look much more favorable.
What about simplicity? Isn't 115 simpler?
It can seem simpler upfront, maybe quicker, but that potential tax downside could easily wipe out any perceived simplicity benefit. Dilution is another factor. If avoiding dilution is the absolute priority, 115 still does that.
Anything else?
Yeah, consider future plans. Are they likely to want to repay these funds? What's the specific funding need for? How complex is the company's capital structure already? It's a multi-factor decision.
And what are the common mistakes people make? Where do things go wrong?
Several areas. Vague wording in the articles about share premium availability is one. Not following the distribution procedures correctly, missing the interim balance sheet, for example. That applies to both.
What about specifically for 115?
The big one now is probably not having a really clear, robust contribution agreement that explicitly states no shares are issued. Also, just generally misunderstanding or ignoring the net asset test that catches people out.
And the tax side?
Overlooking the tax implications, especially post-2022 for Count 115, is a major pitfall. And across the board, just poor record keeping can cause headaches later on.
Right. To help avoid those pitfalls, maybe we can quickly outline a checklist for distributions or repayments.
Good idea. First, check the articles. Assess the financial position. Can it pass the net asset test? Then, the board meets, formally proposes the distribution, crucially referencing an up-to-date interim balance sheet.
Then convene the shareholder meeting properly.
Yes, get the shareholder resolution approving the specific amount, execute the payment, and finally update all the records, accounting, shareholder register, minute books. Follow the steps meticulously.
Okay, looking at the landscape now, any very recent developments, besides that huge 2022 ruling which seems to dominate?
That 2022 ruling is still the main event, honestly, for Count 115. There haven't been any other sweeping changes to the core company law, the LSC, directly hitting how share premium or 115 function corporately.
Anything else on the radar?
Well, it's maybe a side point, but for SUFs, specialized investment funds, their subscription tax base does include paid-up capital plus share premium. And there's talk, a proposal to increase the minimum subscription tax they pay.
But that's a tax rate thing, specific to SEFs. Doesn't change the nature of share premium itself.
Exactly. It's a tax base and rate adjustment for that specific fund type, not a change to company law definitions. There's other noise out there. ESMA guidance on ETFs, government programs like Zukunft AED, some individual tax credits, CSSF circulars for banks and investment firms.
But none of that directly changes the rules for 111 or 115 as we've discussed them today for general companies.
Correct. Those are mostly sector-specific or broader initiatives, not fundamental changes to these equity mechanisms themselves.
So looking forward, any predictions? Might we see lawmakers react to the 2022 ruling on Account 115?
It's certainly possible. That ruling created a clear divergence, a tension almost, between the corporate form and the tax treatment. So further scrutiny, maybe even legislative clarification or adjustments down the line, I wouldn't rule it out.
So vigilance is key.
Absolutely. Staying informed, getting expert advice, especially on the tax side, is crucial. The landscape could still evolve.
Okay, so let's wrap up the key takeaways for everyone listening. Share premium and Account 115 distinct ways to build equity in Luxembourg. Different characteristics, different implications.
The net asset test is non-negotiable for any distribution. Whether it's repaying premium or funds from 115, procedural rigor is vital.
And that 2022 court ruling fundamentally changed the game for Account 115's tax treatment under the participation exemption. That's a massive takeaway.
Huge. And finally, documentation, clear articles, robust agreements, especially for 115, detailed minutes, it's all indispensable.
Hopefully understanding these points helps you navigate your roles, whether in law, finance, governance, or compliance. But always, always seek specific expert advice.
And keep an eye on future developments. It's fascinating how these technical details can ripple out with such significant consequences.
It really is. Hit that subscribe button. It was the Luxembourg Fundcast for you today.